You know, things are getting bad when Warren Buffett and Jamie Dimon are warning about stocks getting ahead of themselves. You came here for the truth, so let me unveil that for you. Today, we are going to look at the extremes of the extremes. And can you believe it? It might just get more extreme. Yeah, I'm not kidding. Look at this. You've got Jamie Dimon saying that before any crash, it felt great. Jamie Dimon isn't sold on the good news coming out of the US economy, saying that it may prove a precursor of a recession. Now, we don't know what's going to happen before it does, but I have read the history, and I know that he has as well. And if the permanently high plateau, the most famous of all lines from a failed economist, happened to then, literally weeks later, come the biggest crash we have ever had up until that point, and still today, 89% down. 1929, from the top to the bottom, 89%. And of course, we know what happened during the Great Depression, but it wasn't after the Roaring 20s that it took all of that growth. And then we had the problems. You see, everything was so great during the Roaring 20s, wasn't it? But then what followed was chaotic. Big tech's roaring profit machine eases fears of rally reversal. Yes, there's no question about this. What we are seeing today is very different from what we had back in, the dot-com boom and bust. I believe it's different. And the reason I say that, yes, this time is different. The reason I say that is because what we had in 2020, my opinion, that was a lot like the dot-com boom and bust. Today, we have actual real companies like Apple or Amazon that are doing exceptionally well overall. And their businesses, they have tons of customers and things. Back in 2020, people were buying into things that were nothing. In fact, I think I have that one set up already where you can look at this. Let's just take a look at it for a sec. Okay, we'll fast forward. There are many companies that are severely down, way down from where they were. Oh, in 2020, Zoom is going to be the next big thing. Yeah, we're still using Zoom. I use Zoom on my Friday and Sunday live sessions. Great. I pay them. Yes. And the only reason I pay them is because I need longer than 40 minutes. Okay. But look at Peloton. Is everybody going? Did everybody quit the gym? Did everybody drop the gym and then they went all on Peloton? For a little bit, maybe. But people were buying $3,000 bikes. And then that started to turn around. DocuSign. Do people use DocuSign today? Oh, absolutely. But what happened to the stock? Down 83%. Etsy, okay, it just got caught up in this whole excitement. And Moderna, I guess they needed to make some weight loss drugs in order to get very popular at this time, because that's what it's all about now. And so we got to remember that. Why are these stocks going up? The ones who have genuine business that are not based on this future ideology of, it's AI. Oh, the future is AI. Therefore, this company's going to do well. That's not what should make a stock go up. It has to be based loosely on where the sales are. Okay? Or you got to have some piece of technology say, hey, look, this is what we're working on right now. It's in development. It's not this, pie in the sky thing out in the future. If you see that, you have punishment coming your way. Okay? Don't believe it. This is talking about the dollar, the US dollar. There's no question about it. I have talked in depth about how the US dollar ultimately is being devalued significantly. And there are some who they don't understand how it works. They're like, what are you talking about? I see the dollar and I think it's doing well. Well, that's compared to its peers. So you want to compare the dollar to what? The Mexican peso? You want to compare that to what other currency are you doing that with? But of course, here we have it. So the trade weighted dollar nears the 2020 era highs. Okay, so you're going to see like depending on the way you measure this, that the US dollar overall is going to look very strong, but it depends on its position. There's no question about it. The US dollar itself, it's being devalued against real goods. We know this to be a fact, but we also have to understand that it depends on its position of how tight their monetary policy is. So if they say, hey, we are going to keep rates higher for longer, the US dollar can get stronger. That's the way it works. So keep that in mind, okay? This is showing us breadth. So for my Finance Friday live crew, look at this right here. I want to cover this, by the way, Finance Friday. I know you're listening. I'll cover all these charts in depth on Friday, but for now, get a little sneak peek. NYSE breadth measures high, but not yet near extremes. So we are getting this. The breadth is bad. What does that mean? Essentially just looking at, the positioning in total, like how many stocks are actually doing well. And it's saying we're in the 85th percentile. So 85th percentile meaning, generally we don't get this level of breadth. And hopefully the idea here is that other stocks start to come up, not that the high-flying stocks come down. That's what they're hoping for. Current bull market is historically mild. So I said to you at the beginning, it could get worse. It could get more extreme. And here we have it. Looking at this, today's bull market is towards milder of historical ones. Now, what I would like to note here is that today we have a select number of stocks that are doing well. When you look at it equal weighted, so imagine you took the S&P 500 and you did it equal weighted. So all 500 stocks equal weighted. The performance, it's very, very poor, and it hasn't moved all throughout this period. And of course, that's, there's always going to be poor performers, of course. But it just gives us a little sense of how well certain stocks are doing versus the general market. Excess liquidity can keep the bull market going. We're in a tight environment still, according to the Fed funds rate. Of course, looking at, liquidity overall, that's a different story. But when we talk about the Fed funds rate, imagine we haven't even dropped rates yet. Look at Bitcoin. At the time of this recording, it's, I think I read 57,000 or something. Look at what's going on with stocks in general. I mean, just imagine what happens. They say, okay, we're going to start cutting interest rates. Okay, we're going to stop quantitative tightening. What do you think is going to happen? This thing is going to go berserk. Now, that ends badly. But before that does, we're going to party like it's 1999, baby. Rising money growth supporting global excess liquidity. I thought it was interesting just to look at the G10 M1 growth becoming less of okay, so just look at this for a second here. We are seeing this specifically right now, today, where we have economic growth going year over year, moving in an uptrend. All right, that's one thing. But when we look at the actual money supply, okay? When I look at the money supply, I think to myself, this has to move up in relation to the total economic growth. So like GDP numbers, right? They both have to move up together. And if they don't, that generally insists that there's something of a mismatch, there's a problem, and then let's just say it fixes itself. When we don't have growth to support this, you have a lot of money printing, but no real growth, then you have inflation. You need the economy to be growing at this time if you're going to have money growth. And of course, they work hand in hand. And so we're seeing that right now. I'm concerned about what's happening here because they haven't even really stepped on the gas at all. So the level of inflation that we are dealing with, I would say that for the most part, it's going to be very painful coming up. I'm just got to be honest with you, okay? Just looking at where we are, the likely scenario is a especially if there's a little bit of deflation. Like if we get deflation, the end result is a very painful deflation. Okay. This is just showing us the winners and the losers, which I showed you a moment ago. Here we have Warren Buffett. Okay. So the letter to the shareholders talked about this. All in all, we have no possibility of eye-popping performance. That's a quote from Warren Buffett. That's what they do, right? He's saying, hey, we've missed a lot of opportunities, this and that, but based on many factors, no possibility of eye-popping performance from here on out. Like saying like, hey, we really squeezed this thing big time. That's what he's saying. And then we have Cathie Wood, everybody's favorite, selling into NVIDIA frenzy again and cuts TSMC stake. So is she now right? Or, how do you want to play that? Because she would have been royally wrong many, many, many times all throughout, burning investor capital, continuing to be let on CNBC and Bloomberg and all the rest. And meanwhile, here we have her selling shares. I'm interested to know what you think about that. So the idea here is that we are at this very unusual time frame in history because we have way too much liquidity that's in the system from a few years ago. And imagine like a bunch of storms, like a Sharknado. Okay, we have a Sharknado happening right now. Never watched that movie, by the way, but just the title enough is funny. And just imagine this thing barreling like a whole bunch of trillions upon trillions of dollars just ready to envelop this whole system. It's coming. All we need is a reason. Who knows what's going to happen, where we're going to be at, banking crisis. I mean, it could be anything. But this is where we are, here and now. If you want to join the group on the Finance Friday Live and get these things in depth for literally 2 hours. 2 hours on a Friday. I hope that you'll join me on there. Link is in the description. By the way, I'm selling my whole YouTuber setup. If you are interested in the cameras and all that stuff, everything I have will be listed down below. Just email me, david@themoneygps.com. Getting rid of everything for like half off or probably less. If you're interested in that, david@themoneygps.com, and I'll see you tomorrow. Take care.